Start our webinar. Welcome everyone and Happy New Year. And first of all, I want to congratulate everyone joined here. You're taking the right decision to join and spending the time on your new year. And just by being here, you're already taking a step that most people miss. This is completely knowledge session, and I'm also IT professional, just like most of you. For over the years, my focus was exactly what most of us would do, like earn more and learn new technology to be relevant into this critical job market. And we all know how critical it is to learn the new skills and all. At the same time, taxes and long-term tax strategy is also plays main role in our wealth building strategy. That's where like I'm going to share some of the learnings and understandings I'm having. So mainly like here today we are going to talk about tax brackets, asset allocation, and location strategies, and contribution limits. And IRS will be making changes every year, like when compared to the last year. This year, tax brackets will be changing, and at the same time, inflation adjusted related changes will be made. IRS will be making, and all everything I'm going to share. These are the essentials for as we are starting the year. Every working professional should be knowing. Based on that, you need to allocate or plan your strategy at all. Okay, and before going into other slides, like I will share some important disclaimer. These concepts are based on purely my research and understanding. And again, personal finance is completely personal, and there is no one solution fits all. Like taxes are, it will be changing based on your family situations and all. And I see diverse audience here. Some of you might be in the starting of your career, and some might be already experienced, and will be in different age level also. But the slides, the presentation today I'm going to share are mostly relevant to the different wide audiences, like maybe in your starting of your career, or at the later stage also it will be helpful. And yeah, and another disclaimer is like at least if you get one point from this presentation, that solves the purpose. It clicks you something, okay, this I'm missing, and maybe I can better utilize this. That solves the purpose of this presentation. Again, I'm not going to sell anything here. I'm not going to get any commissions from any of the recommendations or strategies I'm going to share, so that like you're in safe hands. But Global FinTax is an organization, it's a tax focused organization. We will provide different solutions. Share like some of the solutions are like, so you can see like either personal or corporate related taxation, accounting, if we have that also. Okay, so now let's go into the main concepts of your journey to tax optimization. Like as I mentioned, like the idea or the main points I'm going to share here is understanding the tax brackets. So from the last year 2025 to this year, there are many changes happened, and there are types of tax brackets. You might be in a different tax brackets based on your income range and all. I'm going to share that also. And now, apart from the ordinary tax brackets, we are having capital gains tax brackets also. I'm going to share that information. Most of the cases, like we will be in ordinary tax brackets, but when we go into capital gains tax bracket, then it will make more sense for our allocation strategy and all. That also I will share. And asset location strategy. So that means like where we can invest better than what we can invest. Like if you know like where we are able to, or we can able to locate our assets, then allocation in the sense like we can allocate percentage based, some percent in stocks, some percent in bonds or real estate and all. That I'm not going to share. The today's agenda is mainly the location. I mean, where you can able to locate your assets. That's the main focus. And next is about contribution limits. Being a working professional, we're having different contribution limits related to 401k, HSA, IRA, and all. I'm going to share those also. Yeah, one moment. Okay. Okay, let's go into this. So these are the tax brackets. So you can see like uh, you might be in one of these tax bracket, either 10% to 37%. If you remember, like previous years, in Tax Cuts and Jobs Act is the one, like in the 2017 when previous Trump administration, they introduced Tax Cuts and Jobs Act. At that time, like these tax brackets used to be more like a 10%, 15%. So this tax bracket, instead of 12%, it used to be 15%. Sorry for that. Now looks like you're unable to see the screen. Now you're able to see the screen, correct? Okay. So the coming to the tax brackets, there are many changes from 2025 to 2026. Like you might be in one of these tax brackets, either from 10% to 37%. These tax brackets used to be higher. Like previously, Tax Cuts and Jobs Act used to be there, but when Trump previous term, like 2017, these tax cuts, these tax brackets got decreased. Previously, this 12% used to be 15%, 22 used to be 25%, and that 37% used to be 39.6, almost to 40%. So these tax brackets has reduced now, and even with the new bill, one big beautiful bill act, these tax brackets continued, like instead of increasing, they are maintaining the same tax brackets. And in the 2025, when you're in the single filer tax status, then you're into this range. Now it got increased based on the inflation adjustments and all. So these are the increases. Like you can say, like if we are in the 22% or 22.4% tax bracket, like this much increase, like even your salary got increased, but still you're paying the same 22% or 24%, or in case you're having more salaries and all, you will be in 37 tax percent being a single filer. But if you are a married filing jointly, these are the different tax brackets. Here also you can see there it is an increase for your tax brackets and all. So based on that, like, okay, and again, one more point I want to highlight here is these are progressive tax brackets. Like, for example, if you are in 24% tax bracket, that doesn't mean like complete salary you're paying 24%. So it is progressive, as I'm mentioning. Initial range of like if you are in married filing jointly, 24%, 24,800, you will be taxed at 10%, and if you are in 100K tax brackets, then you will be paying first 100K, you're paying only 12%, like that. Like it is progressive, and based on that, like 24%, you'll be paying only between this range, like 201K to 403. Only 24% you're paying. That means like it is progressive. Okay, once you understand these tax brackets and it is progressive in nature, based on that, like you can able to allocate your strategy and all, how you can, where you can allocate your investments and all, you can able to plan better. But from these tax brackets, like instead of 10% to 37%, how you get reduced in the tax brackets, like for example, instead of 37 tax brackets, you will be there, you will be earning, and on the earnings, the amount you earned, and it got credited to you. And once after that, like how you can able to plan your investments and all, and again how to reduce these tax brackets. And once after that, like your investments, how you can able to make it more beneficial from the tax front. And all these tax brackets I'm referring are only federal, but apart from the federal tax brackets, you're having like state and local taxes, all taxes will say, and many other taxes like sales taxes, property taxes, those will be extra. Here we are only talking about federal tax brackets and salt tax bracket and other tax brackets we are not referring here. Please make note of it. Okay, and now how we will go from these tax brackets and how we will make like how we will pay less tax. We are not anyhow we are not going to pay zero taxes as we were discussing. These are only federal. There are many other taxes we are going to pay. That's why there is a saying like taxes and death are only certain. So anyhow we need to pay taxes, but here the strategy is how we will plan our investment better and reduce our taxes using our investments and all. Okay, so before going to that, we need to understand the standard deduction changes also when compared to 2025 and 2026. Uh, if you are in a single filer, 24 it used to be 14,600, and now in the 2026 it got increased to 16,100, and similarly for married filing jointly it is increased to 32,200. So that means first of your earnings until 32,200 you won't be get taxed. Standard deduction is most of the cases. I understand from the statistics around 90% of the people uses standard deduction. So it got increased despite of all the turmoil in countrywide and internationally happening. The tax brackets wise, at least we are in good shape. So I mean, like standard deductions got increased and inflation adjusted. Even our tax bracket also got increased, and at least from the tax perspective, we are in good shape. And last year, uh, we got an act, like one big beautiful act in the mid-year of 2025, around July timeframe. These standard deductions also got increased. It used to be 15,000 pre-OPA, and it got increased to 15,750. Even though it introduced during mid of the year last year, we can able to use these brackets throughout the year. July it got introduced, but 31,500 is applicable throughout the year. And for this year 2026, it got even increased further. Okay, so now you understand about tax brackets. Now let's go into capital gains tax brackets. This is very important concept everyone need to understand. So I'm just discussing only single filer and married filing jointly, but there are other filing statuses also to make it easy to understand. I'm going to share only about these two filing statuses alone here. Okay, if you are in a single filer status, if you are having an income from your investments, it's not earnings from your salary, but it's an investments. You made an investment and it earned 49,550. Sorry, 450, and you are not going to pay anything. So that means, like, for example, so you invested some amount. It may be $100 or maybe 100K. On top of that, you earned 49,450 in the maybe as a profit, as a dividends. You are not going to pay any taxes, 0%. Again, for the married filing jointly, this is the range 98,950. For example, you invested 100K and you got profits on top of it, like almost like 100K becomes 200K. You're not going to pay any taxes, but the catch here is you need to keep it for 1 year. This is applicable for long-term capital gains alone. If you are redeeming or not investing for a year, you're less than a year you're keeping and you're redeeming, then you need to pay taxes as per your tax brackets. For example, you invested and you withdraw that amount, and again it goes back to ordinary tax brackets, whatever the tax bracket you are in. So the idea here is like we need to have investment strategy, so that like we can able to get better tax rates than ordinary tax brackets. If you are, instead of paying 37%, if you are in the highest tax brackets, if you invest your money, then you can able to go into these tax brackets. But you need to have additional income in the sense like some buffer income for investment purposes. So I see many of you might be in your earlier career. You might be thinking like only wealthy people will be getting the tax benefits, and we are paying more taxes, all those things. But if you can able to spare some amount or from whatever your earnings, it can be anything, it doesn't matter your salary, but you having a minimum of $100 or whatever the range it may be, you can able to invest, and you can able to go into these tax rates. You can able to pay less taxes for your earnings. So that's the main idea here. And you know then understanding tax brackets. Yeah, this is again the same thing. You please understand, like ordinary income tax brackets, we already discussed, it is between 10% to 37% based on the income level. But capital gains tax brackets, it will be under 0 to 15% or 20%. This is the maximum. That's what I was highlighting here. So even you are having your profits more than 613K also, you're paying only 20%. But here, if you see the similar range, 630, you might be, if you are married filing jointly, might be falling under 35% tax bracket. You need to pay around this 35% taxes. So you need to pay, but you're earning after 1 year, like earning long-term taxes, you're paying only 20%. I wish everyone will be using this method and able to invest even the small amounts. Also, stock market facilitate small investments also, correct. Based on that, try to go into this uh, tax brackets. I cannot say like tax brackets is capital gain tax brackets. So this is a long term capital gains taxes. And if you are in real estates or bonds and mutual funds, all those scenarios, like you can able to keep for a year, then that will be helpful. Okay. And I want to pause here and please spend some time to understand these two codes. Wealth is what you didn't spend. And this is again personal, and whatever the wealth you are uh, building, if you didn't spend any small amount, that helps you go into these tax brackets of capital gains taxes instead of purely relying on the ordinary income tax brackets, purely relying on the salary and all. So whatever able to, you can able to didn't spend and use that amount to invest. That's where you can able to take advantage of capital gains taxes. So that makes like the main difference. That's where wealthier gets wealth. I mean, like rich becomes rich and poor becomes poor. Instead of like you're spending like paycheck to paycheck, the idea here is at least some amount you can able to spare, and you can able to invest and take advantage of capital tax brackets. Then you will be in better position on the long run. And again, coming to compound interest is the eighth wonder of the world. This quote: "He who understands it earns it, and he who doesn't pays it." So instead of just we are investing and the investment is getting earnings. Again, the earnings also gets earnings. Like for example, you're investing some amount, it ends like after 1 year, it may be created dividends or maybe some profits. So the profits or dividend again started earning. That is the compound interest. But if you didn't understand and you are into some bad debt like credit card debt and all, that's reversing. That strategy is completely reversing. So this is a everyone need to understand. Like some people say like I'm having credit card debt and all, I'm paying minimum investments, minimum payments and all. Then once it started accumulating the bad debt and it started reverse compounding, that is going to be a worse scenario. So if you understand these two codes, based on that, at least you can able to spare something and you can invest that amount, then it will be helpful, for long-term wealth building. And again, the compound interest without paying any taxes, it will make more wealth for you. For example, here we're discussing about ordinary tax brackets and capital gains tax brackets, but this compounding interest without paying any taxes, there are some asset location strategies I'm going to discuss in the coming slides that helps you to build long-term wealth without paying any taxes also. Okay, let's go into next topics here. So for that, we need to understand, as I was mentioning, compound interest into a zero taxes, correct? For that also, you need to have some additional amount. Now, so here we are discussing about wealth is what you didn't spend, correct? Even a small amount you're having, that's where you can able to utilize all these strategies. Okay, so account types, coming to account types, we're having three different kind of accounts. Okay, one is a tax deferred account and a tax advantaged account and a taxable account. When coming to taxable accounts, these are our banks. So regularly our salary is getting credited and it will be there in taxable accounts. This is after tax dollars. Even you having any after tax dollars, it got credited to your bank account. You got a profit or a dividend at the year end. Maybe your bank account will be having some $5 earnings. Even for that, also you need to pay taxes. So this is a taxable account. There are savings accounts, CDs, and a normal brokerage accounts. Also, everything comes into this taxable accounts. Okay, but we're having other accounts like tax deferred and tax advantaged accounts. Tax deferred accounts are the ones traditional accounts, traditional 401k, traditional IRA, and there are other categories like SEPA 403B. And coming to tax advantaged accounts, here we need to understand this is also after tax dollars, not pre-tax dollars. For a tax deferred account, it's a pre-tax dollars. For this year, you're not going to pay any taxes. The investment what you're making this year, either in your traditional IRAs or traditional 401ks and all, you will get tax advantage for this year, but the earnings what you're having and the profits you're having and accumulated over the years in your retirement, you need to pay taxes for this. And when coming to tax advantaged accounts, for current year, you're not going to have any tax advantages. This is again after tax dollars, and you're not going to get any tax advantages, but it is a tax-free growth. Any dividends, any profits you're having, everything get accumulated over the years during your retirement, you're going to have tax-free wealth. So this is another strategy. Roth IRA, Roth 401k, even HSA, health savings account, and 529 plans, all those things come into this tax advantage category. But it's having some restrictions or limitations, correct? Only this year, this much amount only you can able to contribute to tax deferred or tax advantaged accounts. But when coming to taxable accounts, there is no restriction. So how much you're having, you can able to now keep it here. It's having all the flexibility around the world. You can able to withdraw anytime, and you can now. But only thing is, even a single amount you're earning, also you need to pay taxes for the taxable accounts. But when coming to tax deferred and tax advantaged accounts, it's not the case as we already discussed. Um, Now, once you understand this concept, you can able to uh, allocate your amounts or your investments into either of these accounts. So if you want to allocate it to taxable or tax deferred and tax advantaged accounts, so it's your choice, but you need to have a strategy based on your income limits or tax brackets we discussed. Okay, if you are in this tax bracket, which account will be helpful for you for your long-term wealth building and long-term tax strategy. That is very important for everyone to understand, like which account you should be investing to take advantage and all. Now, let's see the asset location strategy. So here we are not talking about asset allocation, but only we are talking about asset location for tax efficiency. So which account we need to use and what kind of investment will best fit for these accounts and all, we are going to discuss here. So if you are talking about tax deferred account, the traditional IRA, traditional 401k and all, some of the best tax efficient investments. These bonds are fixed income, high dividend stocks, actively managed funds with the high turnover and all. They will fit here into this tax deferred account, and even high dividend. They can even fit here also in tax advantaged accounts also. So some of the growth stocks, high dividend and emerging markets, even REITs. So if you understand real estate investment trusts, they generate like many dividends, monthly dividends, even quarterly dividends and all. But if you're keeping these REITs or high dividend stocks into this taxable accounts, what happened is you need to pay taxes, much taxes you need to pay if you're keeping any of these kind of investments into these taxable accounts. But taxable accounts are best fit for your low cost index funds, so they may not be having like many transactions, many actively managed and all. It's not the case, and you'll be having better advantage, like low taxes you can pay if you're using this kind of strategy here into these taxable accounts. But as we discussed, like it gives all the flexibility. You can able to withdraw anytime and all. Okay, coming to tax deferred or tax advantaged accounts, there are some limitations. Means like, oh, when you can able to withdraw, there are some limitations. So some investments like Roth IRA or even a traditional IRA and all, we can able to withdraw. I will share all those strategies also, even though they are retirement accounts. For example, we can take 401k. We cannot able to withdraw earlier. If you want to withdraw, you need to pay penalties and taxes. Only like 50,000. We can able to take as a loan up to 50,000 from the 401k. But traditional IRAs or Roth IRAs and all, we can able to withdraw also, even though they are retirement accounts. So we need to take advantage of those based on your situations. Life happens and you may be having some emergencies. You will be having flexibility with those accounts also. Okay, next. Yeah, here, we were discussing about tax deferred and tax advantaged. One is traditional and another is Roth. So based on your situation, which tax bracket you are in, you need to take a decision where to invest, either in traditional or in Roth, both having their own advantages and disadvantages. But if you understand, like if you are in higher tax bracket, for example, we discussed like 10% to 37% tax brackets, if you fall in one of those higher tax brackets, then it's better to choose a tax deferred account. That means like you will take advantage of tax benefits for the current year, but at the retirement, you need to pay taxes. But you're in higher tax brackets, better to keep or allocate your investments here into these traditional accounts. But if we are in the lower tax bracket, I see most of the participants here are in your earlier career, and you can able to allocate into Roth IRA directly. Even Roth 401ks also you can able to allocate your investments. Roth IRA is having some limitations of the income, but Roth 401ks anyone can contribute. There is no income limits for Roth 401ks. You can able to allocate it there. Okay, here I put a you know this table. So it's having, if you are in tax rates, if your tax rates are low, better to contribute in your Roth accounts. If your tax rates are high, better to contribute into this traditional account. But when you are withdrawing, so withdrawing during your retirements and all, you need to use this traditional accounts because we're having the standard deduction, correct? So up to that standard deductions we already discussed, you are not going to get taxed. Once after like on top of standard deductions, you may get taxed, but up to the standard deductions, you are not going to get taxed. That's why better to withdraw using traditional accounts. At the time you will be having lower tax rates, but if your tax rates are higher during withdrawal, better to use Roth accounts because the Roth accounts are tax advantaged and you already paid taxes. You don't need to pay taxes during withdrawal years. So that's the main idea here. Okay, this is a very important concept. Now please go through and understand, and based on that you allocate your investments and your allocation strategy for the long-term taxes. Like if you are only thinking about short term, for this year I'm going to get tax benefits, it's not the case. Like you need to pay higher taxes when you are withdrawing. At the same time, traditional account, tax deferred accounts, having many other drawbacks like RMDs. Like they will force you to withdraw once at certain age, around 73 and all. So and again, coming to Roth, this is one of my favorite account. Roth will be used for many situations. Like for example, you are married filing jointly, and you can take advantage of college paying, and you are buying for example, you are in earlier your career, you're going to buy a home. At the time also Roth accounts can be used for up to certain amount, not complete amount. And again, Roth accounts, for example, you are able to contribute directly. You are in your lower tax brackets, you contributed into Roth IRA, and you can able to withdraw next day also. Today you contributed, tomorrow if you want to withdraw, you can able to withdraw it. For example, there are limitations, correct? Only for Roth IRA, you can able to contribute only 7,000 or 7,500. But that 7,000 or 7,500 you contributed now, and tomorrow you got some emergency and you want to withdraw, you can able to withdraw immediately, even though it's a retirement account. No questions asked. We already paid the taxes. You don't need to pay taxes, anything. You can able to withdraw. Okay, those are the advantages of our Roth IRA. And one more important thing I want to convey here is Roth IRA. If you opened and you're doing any trading or any buying and selling, or uh, you invested in some kind of crypto or whatever, even recently, like you see the run of gold and silver, you might have invested and you withdraw, you don't need to pay any taxes because it is in the already paid tax bracket, correct? Like you are in the Roth IRA and already paid, and your earnings and profits, everything will be in that account. The contributions you can able to withdraw immediately, but not the earnings. So on top of contributions, you might be having earnings that if you want to withdraw, you need to pay taxes. Okay, they're having such kind of limitations. Otherwise, for the contributions, you don't need to pay anything. This is very important concept to understand. Okay, and yeah, coming to maximizing tax advantage accounts in 2026. We already discussed there are changes happened for the tax brackets, correct? Similarly, inflation adjusted uh, contribution limits also every year will be changing. For the IRA contribution limits, in the 2025 last year, we used to have 7,000 per year, but that got increased to 7,500 per year. So these are the very important changes everyone need to understand. Again, these are the maximum contributions. Like there is no restriction like 7,500 maximum you need to contribute. Minimum from $1 to anything you can able to, based on your personal situation, you can able to contribute it. But 7,500 is the maximum. If you are in age 50 plus, like catch up contributions you might have missed in your earlier career years and all. So now you realize like most of the cases it happens like people started realizing and investing in their later years, like 40 plus, and some cases 50 plus also. For them, there is a catch-up contribution limits. Previously, it used to be $1,000. It got also increased to $1,100. Total of 8,700, sorry, 8,600. Totally can able to contribute it. So it applies to both traditional and Roth IRA. And I want to share one more information. Like most of the cases, people will be having misconceptions like I'm in the higher income brackets, I cannot able to contribute to a Roth IRA. There is no such case. Like for example, you are in the higher income limits, and Roth IRA contribution directly may not be possible, but you can initially contribute it to traditional IRA, and on the same day you can able to convert that traditional IRA amount to Roth IRA. So that's the strategy that called like backdoor IRA. So you can use that, and irrespective of your income limits, you can able to contribute it to Roth IRA. I mean, convert it, not directly contribution, but you can able to convert it initially into traditional, then to Roth IRA. Again, when coming to 401k, so there is no income limits also, irrespective of what tax bracket, what income limits you are having. Anyone can able to contribute. Their company provides that option of 401k contribution. And it used to be for employee portion, it used to be 23,500, got increased to 24,500 from this year 2026 onwards. So these are very important numbers everyone need to understand, and need to plan their contribution strategy, allocation strategy. 24,500 as a part of employee, we can able to on top of it, like there will be matches, correct? Your company might be matching some percentage, maybe 2% or 5%. Some may not be contributing anything, like a company may not be matching anything also, but from your portion you can able to give 24,500. Again, it's a maximum, so minimum can be anything, and there is no restriction, like you are not even contributing also, there is no questions asked. But about this maximizing our accounts, for example, you missed this year, so you are losing 1 year. So that's why like there are limitations. For example, like Roth IRA, we can take again. I'm going back here. This 7,500 this year, but last year in the 2025, it used to be 7,000. So you still have a chance to contribute for the last year 2025 also until April 15. So you missed to contribute 2025, still having option to contribute till April 15, 7,000 plus 7,500. So you can able to contribute it. This 7,500 you can able to contribute till 2027 April 15. Okay. So these concepts you need to understand. And if you married filing jointly, so you can able to contribute this year 7,500 plus your spouse another 7,500. So both together 15,000 maximum you can able to contribute. So based on your situation, so you can start small, and then maybe you can increase it up to 15,000 also. And when coming to 401k contributions, like here again, the catch-up contributions you might have missed in your previous years or started late and all, 8,000, it used to be, I think, 7,000, a total like 32,500 you can able to contribute as an employee. On top of that, matching will be there. But total limit, it is 72,000. It used to be 70,000. So this is again another very important concept. If your 401k plan configured properly, so if your 401k plan allows maximum 72,000, you can able to contribute it. With catch up, it is 80,500. It used to be 70,000. So there are three different kind of contributions we can able to do for 401k. One is traditional 401k, another is Roth 401k, third option is after tax 401k. So on top of this 24,500 and your company matching, for example, including your company matching, it is 30,000. Let's take an example, and remaining 42,000 as an after-tax 401k, we can able to contribute it. So, but only catch is you plan supposed to allow that. If you plan not allowing, you cannot contribute to this. So that 42,000, again, you can able to convert it to Roth IRA or Roth 401k. So that's called mega backdoor, strategy, mega backdoor Roth strategy. So instead of like, I know life happens and there are many taxes you need to pay, and it's not possible for everyone, but this is the strategy in case you can able to contribute, you can able to allocate to more than 7,500. This is a strategy you need to use. Only thing is your plan supposed to allow. So some companies allow that, some companies won't allow. So those are the restrictions. Otherwise, like 72,000 is the maximum contribution limit for this year 2026. Okay, and coming to HSA, so this supposed to be you're having some HDHP plan, like high deductible health plan. With that only, it allows like for family 8,750. It is for complete family, but not individual. So it's 8,750 the maximum you can able to contribute. It used to be 8,500 in the 2025. It got a little increment as per the inflation adjustments and all. If you might have selected this option in the HSA, this is another very, very good advantage. Compared to IRA and 401k, HSA is having triple tax advantage. Like the contributions will be getting tax free, and the earnings also tax free. When you are withdrawing, the withdrawals for the medical expenses also tax free. That's why like a triple tax advantage they say. And again, this amount also you can able to similarly Roth IRA, how we are able to use that account for investments and all. Same thing, you can able to use the HSA also as an option for your investments. It can allow same options as a Roth IRA, like stocks, mutual funds, or in cases you can able to contribute or invest using these Roth IRA or HSA into real estate, even businesses also you can able to invest in. That is a different strategy, but initially you can start with small amounts, and later on, once you accumulated some amount, then you can able to utilize these options to invest in either in businesses, in real estate, all those things. Yeah, but as a starting strategy, so first try to utilize these income limits. If you're not using this year, it's going to be use or lose kind of scenario. Okay, and yeah, if you're not using or contributing these limits, you'll be losing an year also in your career. That's a very important point I want to highlight here. And again, there are many books and many influences in the social media talking about like these strategies, like maximizing your contributions for this year or over the years. Like you can able to utilize or maximize some of these contributions for couple of years, maybe around 10 years or so. That's it, and you will be having good wealth and even tax advantaged wealth also. That helps your career, and it's very important to understand these concepts and allocate our investments and all, so that like we can able to take advantage during this AI era. We're having AI replacing many of our jobs, workforce and all. So at least we are in a good standing, like we can able to take advantage of all these contribution limits and all. It will be helpful for our not only for career or life also. So that's the point I want to highlight here. And yeah, this is the main agenda. So these are the key takeaways as we discussed. First of all, we need to understand tax brackets. One is about ordinary tax brackets we are in, and how to go from ordinary tax brackets to long-term tax gains. Instead of paying like the maximum 37%, let's invest and pay up to 20% in a long-term capital gains taxes format. Otherwise, And yeah, coming to asset location strategy, way to invest. We're having three different kind of accounts. We already discussed: taxable, tax deferred, and tax advantaged. So way to allocate and what account gives flexibility, that also we understand. Next is about maximizing the contributions for this year. There are many changes happened. Okay, now better to understand these limits and contribute accordingly. And next is like about limit adjustments following the tax laws as per the inflation adjustments and all. IRS will be doing adjustments and increasing the tax brackets. So understand every year what are the changes happen. Based on that, you can allocate your investments and money. Okay, this is the main idea and agenda I'm having here, and I didn't follow any chart. What have do you have any chart related questions? I need to see if having any questions from anyone, or if anyone want to speak, please let me know. I can allow you to speak. It's not going to add incomes. 100K wages. Anyone want to speak? Please let me know. I will allow you for any questions. So Viran, you're having a question about capital gains not going to add as an income. So you gave 100K wages and 200K capital gains, do not pay 300. No. So I'm going through this question about, you can able to see still see my screen, correct? Okay. So if you're having capital gains, you invested 100K and that 100K becomes 200K. So you'll be paying only 100K because this initial 100K, it is your investment, and the earnings are only 100K, correct? The earnings will get taxed, not 200K. Only the earnings will be get taxed. Yeah. Okay. Got it. Yeah. I see Surya already answered that. Okay. So if anyone want to speak, please let me know. Okay, AMT, can you elaborate, Sam? AMT still in effect? What exactly that AMT stands for? Anil Patluri, you want to speak? Sorry. Chandra, want to talk? Yeah, sorry, somehow it is not allowing. I think chat received. Okay, Chandra, sorry, not Chandra, come on. So I'm allowing a couple of you, please talk in case we want. Or, you can reach out to me. We're having this, I'll post like our contact numbers. If you want to, reach out, you can even reach out to us also. Somehow it's having some technical challenges. One moment. Yeah, could you please explain more about 401k 72k limit for self-employed? Okay, so yeah, self-employed case, it's a very uh, ish, so if you are a self-employed and you want to contribute to 401k, maximum 72k this year, you can able to contribute it. As we discussed, only challenge is your plan supposed to allow that. So some of the brokerage firms like Fidelity and all, they may not able to allow maximum contributions of 72,000. You need to choose proper brokerage firm which allows all total 72,000 contribution. So based on that, like yeah, for example, you are a self-employed and you are both employee and employer in that scenario, you can able to contribute it. Only thing is your plan, your brokerage firm supposed to allow that. Okay, and alternative minimum tax is still in effect. Yeah, so yeah, thank you for clarifying that. AMT is about alternative minimum tax. Yes, that is still applicable. Yes. So Bhupesh, I hope you clear that, correct? Okay. Yeah. So Anil brother, yes. So for 401k as an employer, like self-employed, you can able to contribute all 72,000. But what I understand is most of the brokerage firms, they're having some restrictions to make all 72k contribution. You need to choose proper brokerage firm, and you need to configure your 401k plan properly. Then it allows. Yeah, you're supposed to have a profit or revenue to contribute it, like a final end of the year. If you are showing no profits and zero revenue, then it won't be possible to contribute it to 401k. So anyone having any other questions? Previous year. Oh, for 401k contributions previous year, no, not possible for 401k contributions at least. If you're having HSA, you missed, you can able to contribute till April 15, the tax preparing time and all. Otherwise, like a 401k contribution is not possible. So is 72k pre-tax? I need another. Okay, is 72k pre-tax? Both are possible, like 401k traditional and Roth options we are having, correct? For traditional, it is tax deferred, as we discussed, like tax deferred account. And if you are putting into Roth, it is a tax advantage. Both options are available. Either you pay this year or you pay later. Yeah, so assume I have 18,000 from my current employer plus 9,000 in employer contribution, totals 27k in my current employment. What about setting up a separate 401k through our own fund? Yes, yeah, you can do that, Raghava bro. You can do that, like uh, 401k contributions combinedly with your current employer. You are having separate self-employment. Remaining, you can able to contribute it using your self-employment, but total limitation is 72,000, both combined, like your W2 income plus your self-employment contribution is combined 72,000, but you can able to do it that way. So someone is asking in the Q&A about, I want to understand about Roth IRA. Currently, my joint income was around 260K. Am I eligible to contribute Roth IRA? If yes, can you explain? Yes, yes. Yeah, you can do that. As we discussed, like as the income limits got crossed, what happens is you will contribute to traditional IRA, and again the traditional IRA is also after tax. That means like you won't get any tax advantage for contributing to traditional IRA because you crossed that income limit. And once you contributed to your traditional IRA, you won't get any tax advantage. You can just convert that to Roth IRA immediately. You can call your broker and they can help you to do that. But it is possible. Anyone, irrespective of their income limits, they can able to convert it, not directly contribute, but initially you can contribute to traditional IRA. You can convert that to Roth IRA. That is possible. And 401k having no income limits, either it is traditional 401k or Roth 401k, irrespective of income limits, they can able to contribute it. Tagged as highly comp employee, current high compensated employees have a set limit defined by. Yeah, so Raghava Bro, if you're talking about Roth IRA contributions, yes, no, even though you tagged as a high compensated employee, you can able to initially contribute to traditional IRA, convert it to Roth IRA. Doesn't matter your income. Or if you're talking about 401k, yes, you can do that. 401k, there is no income limits. Anyone can contribute it. All right, I think mostly we covered. But in case of having any questions or you want to discuss with us, I already posted, our contact details. But let me post like my phone number also here. So this is our phone number. You can reach out to us, and there is a form in case if you want to file taxes with us. There is a form. You can use that form and reach out to us so that we can help you preparing and filing your taxes, or if having any other needs like setting up an LLC, accounting and bookkeeping, payroll. So please reach out to us also. Any chance for one contribution per PI? Yeah, I think I see Surya, you responded to Chandra's question about the employee 401k. Yes, that's correct. December 31 is the deadline, but some of the cases employer they can able to do kind of true ups up to tax deadline. For example, so you started contributing to your 401k, and now for example you're having a 5% match, but you contributed more than 5%, like 10%, 15%, and before your employer paid that matching, you completed your contribution. So what happens is uh, till December 31, they assume like they won't pay the matching because you already contributed the your complete amount, correct? So they will do true up, they will do all the calculations at the year end, and from the employer part they can able to true up in the next year till tax deadline, but as an employee only till December 31st. All right, so in case if you're having any questions or if you want to reach out, please do that, and yeah, we can conclude this session for today. Thank you folks, have a good one.